Hello, and welcome to PwC Luxembourg's Macroeconomic Barometer. I'm Zoha Ahmed. Due to downturns in the steel and machine and equipment manufacturing industries, the Grand Duchy's industrial output fell by 5.6% in January 2017. Service sector inflation has also risen over the last few months from a low of 0.8% in September 2016 to 1.5% in March 2017. Furthermore, at the end of the first quarter, government tax receipts recorded an annual increase of 5.9% or 200 million euros. These factors contributed to our barometer falling by 1 point this month to settle at 32. However, eurozone analysts and investors remain confident. Eurozone industrial output also stagnated between December and February, although the European Central Bank continues to support the economy through negative key lending rates. According to the IMF, 75% of small European banks are not sufficiently profitable, and the deregulation announced in the United States poses a threat. That said, public deficit in EU member states continues to fall, making up 1.4% of the bloc's GDP at the end of 2016, allowing margins for more expansionist fiscal policies. While capital markets were buoyed by the results of the first round of the French election, the country's GDP only grew by 0.3% in the first quarter, held back by foreign trade. Overall, the mood remains positive. The IMF has revised its global growth forecast upwards to 3.5% for 2017. Meanwhile, China's GDP growth remains stable at 6.8% in the first 3 months of 2017. Nonetheless, capital market confidence seems to be at odds with the economic reality, which the OECD and the IMF see as a real risk. Two other key factors to note are the expectation that the U.S. Federal Reserve will postpone its upcoming increase in the key lending rates until June. The other factor being, UK's GDP grew by only 0.3% in the first quarter of 2017 compared to the 0.5% at the end of 2016, the most sluggish growth experienced since the Brexit referendum. That's all for this month. Thank you for watching.